Hey Bowtie Nation, Joseph Hogue here. Thank you for joining us for a very special video today, a very special initial public offering, an IPO coming from ARM. It's a semiconductor coming trading today. I found something that nobody else is talking about, why the stock price could go even higher than anyone can imagine here. I'm going to give you a hint on this. What happens when you have very little supply of something and some huge demand? Yeah, that price is going higher. We're going to get to that ARM IPO, but my goal on this channel has always been to make you a better investor. That's why I created this quick 5-minute guide to finding the stocks that will make you money. Look for the link in the video description, click through, and you're going to get everything you need to analyze the stock in less than 5 minutes. It's totally free, just something I wanted to do for all you out there in the community. So look for that link below. A lot of investors are actually unfamiliar with what ARM is. It's a British company and it's actually in 99% of the smartphones out there. So if you've got a smartphone, you've probably got one of ARM's products. We can go here to the United States SEC, the Securities and Exchange Commission F1 filing. That is the filing that all companies have to do before they IPO shares on the market. And we can go here to ARM's Limited F1 filing. If we scroll down here to page 1, we can see a description of the company, really detailed description of the company, what it's doing. ARM is a semiconductor design firm. Okay, it designs semiconductor chips and the software integrated into more than 250 billion chips globally. Everything from sensors, again, to smartphones and supercomputers. The company estimates approximately 48.9% of the semiconductor design market is just from ARM Semiconductor. Okay, that's against Intel, that's against AMD, while both of those are struggling. So ARM actually designs the architecture for a semiconductor. Again, semiconductors are the brains of a computer. It's the processing power. That chip, that semiconductor chip, is what's going to enable the computer to process artificial intelligence, software, other programs. Okay, so it is crucial that it has that brain power, the semiconductor chips that are powerful enough to run those programs. That's why Nvidia has done so well this year. ARM is another one of the leaders in that CPU segment. We're going to talk about the difference between CPU and GPU later, but ARM is designing, the architecture is designing those chips and then passing that on, licensing that technology to other companies to fabricate, to manufacture the chips, and then to still other companies to use those chips as well. And here on page 7 of the company's F1 filing for its IPO, and I recommend everybody read through at least the first sections of these, where it describes the company, it describes the evolution of the company and how it's competing, because some very important information for investors out there. But here on page 7, you see the market opportunity. ARM, the IPO, estimates that the total addressable market, that's the TAM here they're talking about, total addressable market for their product is $202.5 billion, rising to $246.6 billion by the end of 2025. So that is a compound annual growth rate, an annual growth of 6.8% in its market, already a $200 billion market, but growing to almost $250 billion there by 2025. If we scroll down here to page 9, where we see competitive strengths, and again, folks, this is so important. If you're investing in some of these growth industries, these big themes that are driving changes in our world, you want to look for competitive strengths in companies. It's not enough just to be investing in a stock that is competing in a growth industry. Yes, that is going to help push that stock higher, because all the stocks higher in that growth industry, that growth theme, are going to be rising. But you want to find the company like ARM here, that I believe, like ARM, that has that competitive strength against its competitors, against its rivals. That means it's going to be taking that market share away from those rivals. We see here the competitive strengths on page 9. It has that technology leadership, proven capabilities across the markets. Approximately 39.7% of the market share there in 2020, from 2024 or 2014 up to 48.9% market share in 2022. So this is crucial. This is what you want to look for in any stock you're investing in, is that increasing market share. Okay, what ARM here is saying in this first paragraph, it's saying that it only had 40% of that market share for CPU technology. That's CPU chips. Only had 40% of the market share in 2014. It has grown that to almost 49% right now. Over the last 8 years, it's grown that by more than 10%. Okay, that notes a competitive strength that this company has, that is able to compete against rivals so effectively that it is taking share of the market from them. We can scroll down to page 18 here of that F1 filing. And this is where the rubber meets the road, folks. This is where we get that valuation, because this is where we see the financials for this company. We can see 3 years of financial data for ARM. We see 2023 all the way back to 2021 revenue, profits, profit per share for the company. And what's really interesting is, contrary to a lot of the other stocks that have IPO'd over the last few years, ARM is profitable. ARM is reporting 51 cents a share in profits, $2.7 billion, almost $2.7 billion in expected sales this year. Now, if the company does price at about $55 billion for the entire company, we're going to talk about how many shares are going to be available and why that means this stock could go much higher. But if the company does price right around $55 billion total company value, that's going to be about 20 times price to sales. Okay, so we see if we have $55 billion, and we can look at that here. If it prices the company, the IPO, total amount of the shares in the market, prices at about $55 billion. We had $2.679 billion in sales expected this year. That is going to price the company at a valuation of 20.5 times on a price to sales basis. We're going to see that here. We got $2.68 billion in sales. Now, it's interesting that that is slightly down from last year. So, contrary to something we see in Nvidia. So we'll look at Nvidia as a competitive chip company. Nvidia in those GPU chips rather than the CPU chips that ARM is competing in. Nvidia is seeing 60, 70, 80% growth year over year. We do see a slowdown in ARM just because of the slowdown in smartphones. A lot of smartphone demand has slowed down over the past year, as well as laptop computers. But we do see a slowdown here, even though it still has that dominance that should drive this revenue much higher into the future. So again, as its closest competitor, I would compare this against Nvidia Corporation, okay? Another designer of semiconductor chips, one of the leaders in the group. You've also got competitors like Intel, like AMD, but they don't have that competitive advantage. They don't have really the true capabilities that these two companies have. So Nvidia and ARM are really going to be leading this industry, this semiconductor industry, in growth and in potential. So I want to compare it against Nvidia, compare it especially on those valuations. And we see here that 20 times price to sales. We see here Nvidia trading right now at about 34 times price to sales, as low as 11.5 times price to sales there in the trough in 2022. But right now trading for 34 times on a price to sales basis for Nvidia. That's comparing to this potential 20 times price to sales for ARM. So ARM much cheaper on this basis, but you also have to consider the growth of these two companies. So I want to come back to that, but we're also looking at the price to earnings. Okay, right here, Nvidia trading at a price to earnings of about 108 times, almost 110 times. That's actually going to be pretty close to what we see with ARM. I think ARM is going to be trading at its open right around 105 times on a price to earnings basis. But now, again, we have to consider the difference in growth, because we looked at those financials there on ARM. We saw that was just growing, actually declining sales over the last year. Here we see declining sales just marginally over the last year. Very strong sales growth from 2021 to 2022, though, and I believe that sales growth is going to come back to at least 10% sales growth a year. But we do see a declining earnings and sales over the last year. So if we compare that to growth in Nvidia, we see this year, current year 2024, fiscal year 2024, expected sales growth of 88%. Okay, expected sales growth 49% next year. So Nvidia might deserve those higher valuations, might deserve that 34 times price to sales basis versus a little bit cheaper ARM, just because of the difference in sales growth here. Now, I got to tell you, normally I wouldn't invest in IPOs, okay? These initial public offerings, they usually come with a lot of hype. The companies always go out on the road shows, hyping up the stock to institutional investors and family offices trying to get those big investments and really hype these IPOs in the market. And that means those share prices go through the roof those first couple of days. And a lot of times, the return just isn't there for regular investors that get in on that IPO day. We see here some IPO data over the years, and we can scroll down here to some graphs. We can look at chart 3 here. This shows the over or under performance of IPO stocks from that IPO date against the Russell 2000. Now, the Russell 2000 is the small cap index, so it's kind of like the S&P 500 market index, except it just covers those smaller stocks. Now, generally, when stocks do IPO, when they first issue shares on the market, they are smaller companies, under $3 billion market cap. Obviously, ARM is not one of those. ARM is going to be a $55 billion company to start on the market. So it's not quite comparable with the Russell 2000, but this graph just shows IPO returns after the IPO against that index. And you can see here, green is going to be an outperformance and a red an underperformance. And you can see here, as far as 3 years out, 64% of the stocks that IPO are underperforming the market. And you can see the magnitude here. This dark red is worse than 10%, so negative 10%. So 64 stocks that IPO'd 3 years out from that IPO, they are underperforming just a straight investment in the Russell 2000, in that index, by at least 10%. Only 29% of the stocks that IPO after 3 years are beating that index by 10% or more. But the ARM IPO will be different, and this is something nobody is talking about right now. I believe this is the reason why those shares will jump higher, not only on this first IPO day, but over that longer term. If we look at some of the data for this IPO, and we can see this in the CNBC article here, just 9.4% of the company, just 9.4% of those shares is going to be available in that NASDAQ IPO. Okay, there's 95.5 million American depository shares, so those ADS. Remember, because ARM is a British company, it has to file through an ADS filing with the NASDAQ. So those shares, they're going to be equivalent to the actual British shares there, though. That's just 9.5% of the company. That means SoftBank, which bought the company a few years back, is still going to own almost 91% of the company. And that's where we get this big supply-demand reason that the shares will be hot. So put this together with something I'm going to talk about now. Just 9.4% of the company shares available in this IPO. That's about 95 million shares going to be available for buying and selling on the stock market until SoftBank releases some of its own shares. We know strategic investors like Apple, Google, even competitors like Intel, Samsung, and Nvidia, semiconductor firm TSMC is investing over $100 million alone in this IPO. This IPO is 10 times oversubscribed. And when an IPO is oversubscribed, that means the institutional investors, the family offices, these strategic investors, these partners like Apple, Google, even competitors there, they are requesting more shares than is even going to be issued in the IPO, more shares than is available. And now part of the reason why this IPO is so hot, why there are so many strategic investors, it is so oversubscribed, so many of these companies like Apple, Google, TSMC are trying to get as many shares as possible, is because of this failed attempt by Nvidia to acquire the company back in 2020. Okay, back at that time, Nvidia went to SoftBank. They said, we want to buy this company for $40 billion. Now, ARM does compete in that GPU market, that graphic processing units, chips, that Nvidia is the #1 leader on, but it's ARM technology is in that licensed CPU, where it is #1 by a long shot. Again, 99% of the smartphones out there use licensed ARM CPU technology. Nvidia wanted to combine that with its leadership in GPU markets. Of course, that acquisition was shot down by regulators because it would just create everything. It would create a monopoly on GPU and CPU dominance for this one company. So now we have every tech company that uses chips, which is every tech company. Again, remember, anything that processes any kind of program, software, computers, smartphones, anything needs a CPU unit in it, or a combined GPU CPU, and needs that ARM technology. So every tech buyer wants a piece of this ARM IPO so it can lock in that supply and that CPU technology, that license, without having to worry about someone else like Nvidia coming in trying to buy these shares off of the market, or buying the company from the market, really controlling and cornering that market. So putting all of this together and what it means for the stock price, with just 95 million shares trading, and we know a majority of that isn't going to be available on the market. Okay, these strategic partners, that investment by TSMC, by Apple, by Google, by Intel, by AMD, by Nvidia, these are all strategic investments where they want to lock in their portion of ARM, so they know that no other company can get a controlling share of this, of this company, and buy out the whole company and control that CPU technology. Those shares, the shares held by institutional investors, they are not going to be trading. Those are long-term. The institutional investors are long-term return investors. They're going to hold those shares. Those strategic partners, those are long-term strategic partners. They are not going to be buying and selling those shares. So of that 95 million shares traded, we might have half of that even available for trading on the NASDAQ. Now consider this, Nvidia has more than 50 million shares traded on any given day, and that's just a fraction of their shares available. Their shares available on the market is 2.4 billion shares. So back to that hint I gave you at the first part of this video, why I think these shares are going to keep on going higher. What happens when you have millions of investors trying to buy these shares every day, tens of millions of shares demand, tens of millions of shares volume every single day for this, and only 30 or 40 or 50 million shares available on the market? Lower supply, higher demand, shares are going to get pushed higher. Now, that is not to say that ARM is not without risk. Okay, you've got first just the general risk of a slowdown in semiconductor demand, slowdown in the economy. You've got another risk that another company takes some of its market share. Some of these other semiconductor companies develop the kind of technology that replaces ARM in smartphones or other products. But the biggest risk here, we can go to the, again, to the F1 filing with the SEC. If we scroll down to page 29, we see the biggest risk isn't valuation, but China. Okay, China is a huge risk for this company. ARM runs all of its China business through an independent unit called ARM China. Okay, this is an independent unit apart from the parent company. It's the parent company, so ARM's single largest customer, 25% of sales go from this ARM China unit. Okay, so even though it's called ARM China, just consider it a separate company because it is totally independently managed, independently run. This ARM China accounts for 25% of the revenue for that parent ARM unit there, the British company, okay, and so forth. The ARM shares traded on the stock exchange. As an independent unit, ARM, the parent company, has no control or management rights over that ARM China unit. As we see those frictions develop between the US, between China, between Britain and China, as that develops, that semiconductor war rages on, this could be a big risk for ARM. Now, I don't think it's a deal breaker for this. We've already looked at the dominance of ARM has in that CPU technology, that CPU market against other firms. We've already looked at the supply-demand imbalance in these shares and why that is going to push this stock higher. But I would be cautious on this ARM China development. Okay, my strategy, as always with any new stock, especially IPOs, is to invest half now, save some for over the next 3 to 6 months. Okay, this is especially true for IPOs where they generally get hyped up, that share price goes through the roof on the IPO day. You can still invest in that IPO just in case it continues to run higher, but you want to save some of your money back for over the next few months, over the next 3 to 6 months, in case it does start to come down. You want to build a long-term position in that stock. Get your fast 5-minute guide to analyze any stock free with the link below and know exactly what you need to look for in a stock. Or click on the video to the right to see every dividend stock in my portfolio ranked from best to worst. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.